Right then, let's dive straight into the heart of the matter. What exactly are futures? Where did they come from? And why do they exist? Now, the fascinating thing about futures is that they weren't invented by Wall Street bankers in suits sitting in glass towers. No, no, no. They emerged from something far more practical and grounded. Literally. The origins of futures trading go back to the agricultural markets of the 1800s. Picture this, if you will. You're a farmer in the American Midwest. It's springtime, and you've just planted your corn. Now, you won't harvest that corn until autumn, but you're already worried. What if there's a bumper crop this year, and the market gets flooded? Prices could plummet, and all your hard work might barely cover your costs. This uncertainty kept farmers awake at night. So, what did they do? Rather clever, actually. They began making agreements to lock in a price for their corn before harvest time. They'd find a buyer willing to agree on a price today for corn that would be delivered months later. This gave the farmer predictable prices and reduced that gnawing uncertainty. And that, ladies and gentlemen, is essentially what a futures contract is at its core. It's a standardized agreement that obligates both the buyer and the seller to exchange an asset, whether that's corn, oil, or in our case, financial instruments like stock indices at a predetermined price on a specific future date. Now, here's something absolutely crucial to understand, particularly for us retail traders. Most of us will never actually take delivery of the underlying asset. We're not going to have barrels of crude oil delivered to our doorstep. No, we close our positions before the contract expires. Our focus is entirely on price movement. We're speculating on whether prices will go up or down. What began in those agricultural markets has evolved into something truly remarkable. Today, futures trading encompasses not just agricultural commodities, but equity indices like the S&P 500 and Nasdaq currencies, energies, precious metals, cryptocurrencies. The list goes on. It's become a sophisticated, highly liquid, professionally regulated market that operates nearly around the clock. The beauty of this system is that it serves multiple purposes. Hedgers can protect themselves against price risk, speculators like us can profit from price movements, and the market benefits from the liquidity we all provide. Brilliant, really. Now then, this is a question I get asked quite frequently. Why should I make the switch from Forex or CFDs to futures? And it's a perfectly valid question. Many of you will have cut your teeth in the Forex markets, and you might be wondering what all the fuss is about with futures. Well, let me tell you, there are some rather compelling reasons. First and foremost, we have centralized exchanges. With futures, your trades are executed on regulated exchanges, like the CME, the Chicago Mercantile Exchange. This means transparent pricing, genuine order flow, and real liquidity. Compare this to Forex and CFDs, where many brokers simulate the market themselves. It's a bit like the difference between shopping at a proper market with multiple vendors competing versus shopping at a single store that controls all the inventory and prices. Secondly, let's talk about spreads. In futures, you typically get fixed spreads, often just one tick. And here's the beautiful part, they don't widen during volatile periods. Anyone who's traded Forex knows that horrible feeling when you're about to hit your stop loss. The spread suddenly widens, and you get taken out before price has actually moved enough. With futures, what you see is what you get. Consistently narrow spreads that don't change just when you need them to stay tight. Now, here's something rather important. The conflict of interest issue. In many Forex and CFD brokers, they take the opposite side of your trade. Think about that for a moment. When you lose, they profit. That's a fundamental conflict of interest. With futures brokers, they're simply facilitators. They give you access to the exchange and charge you a small commission. They don't care whether you win or lose. They make their money either way. Rather more ethical, don't you think? And for my American friends in the audience, there's a lovely tax benefit. Futures profits qualify for Section 1256 treatment. That's a 60/40 split between long-term and short-term capital gains rates. This can save you a considerable amount of money compared to Forex, where all profits are taxed as ordinary income. The bottom line, futures is where the professionals trade. It's a more regulated, more transparent, more professional market structure. And once you experience the difference, particularly if you're a scalper who needs tight, reliable spreads, you'll understand why so many traders are making this transition. Right. Let's clear up what might initially seem like rather complex financial jargon: derivatives. Now, I promise you, this is much simpler than it sounds. A derivative is simply a financial instrument whose value is derived from something else, from an underlying asset. Think of it this way. Imagine you want to attend a concert by your favorite artist. The ticket you purchase isn't valuable in and of itself. It's just a piece of paper or a digital code. What makes it valuable? The performance it represents. The ticket derives its value from the concert, from the artist, from the event itself. Futures contracts work exactly the same way. When you trade an E-mini S&P 500 futures contract, you're not actually buying the 500 companies in the index. You're trading a derivative, a contract whose value moves based on the S&P 500 index level. The contract itself is just an agreement, but its value rises and falls as the underlying index rises and falls. This is actually rather brilliant for us as traders, because it means we can speculate on price movements without the hassle of owning the actual asset. Imagine if you wanted to profit from oil prices going up. Without derivatives, you'd need to purchase and store actual barrels of oil. Rather impractical for most of us, I'd say. But with oil futures, you can trade based on oil price movements without ever touching a drop of the stuff. The same principle applies whether we're talking about stock indices, currencies, commodities, precious metals, or even cryptocurrencies. The futures contract is simply a vehicle, a derivative instrument that allows us to participate in price movements of these underlying assets efficiently and professionally. So remember, derivative simply means the value comes from something else. Nothing mysterious about it at all. Now, this is where things get rather exciting. One of the tremendous advantages of futures trading is the sheer variety of markets available to you. It's really quite remarkable. You have access to virtually every major asset class, all through a single trading platform. Let's start with the most popular, equity indices. These are the ones most day traders focus on. You've got the E-mini S&P 500 ticker symbol ES, which tracks the 500 largest American companies. Then there's the E-mini NASDAQ 100, that's NQ, which follows the tech-heavy NASDAQ index. The Dow Jones, symbol YM, and the Russell 2000, symbol RTY, which tracks smaller cap companies. Each of these has its own character, its own personality, if you will. But it doesn't stop there. You can trade currencies through futures. Now, these are US dollar-based pairs, not the full range you'd see in Forex, but you've got access to major pairs like the Australian dollar, British pound, Canadian dollar, and so forth. The symbols start with 6, so 6A for Aussie dollar, 6B for British pound, and so on. Fancy trading bonds? You can access US Treasury futures, various maturities available. Interested in commodities? Oh, there's a wealth of options. Agricultural commodities like corn, soybeans, wheat, coffee, even lumber. These are the original futures markets. Remember, the ones that started it all back in the 1800s. Energy markets? Absolutely. Crude oil and natural gas futures are heavily traded. Precious metals, gold, silver, copper, all available. And in this modern age, we even have cryptocurrency futures, Bitcoin and Ethereum contracts that you can trade on regulated exchanges. The beauty of this diversity is that you can specialize in one market and master it, or you can diversify across different asset classes depending on market conditions and opportunities. It's really quite a flexible and comprehensive system. Whether you're interested in quick scalps on volatile indices or longer-term positions on commodities, futures markets have you covered. Right. Let's talk about something that might initially seem a bit dry, but is actually rather important: exchanges, regulation, and data access. This is what separates futures from the Wild West of some other trading markets. Futures contracts trade on specific regulated exchanges, and each exchange manages particular asset classes. The big one, the one you'll hear about most often, is the CME, the Chicago Mercantile Exchange. This handles equity indices like the S&P 500 and NASDAQ, as well as currency futures and certain commodities. It's the heavyweight champion of futures exchanges. Then you have NYMEX, the New York Mercantile Exchange, which specializes in energy products. If you're trading crude oil or natural gas futures, you're trading on NYMEX. COMEX handles the metals markets: gold, silver, copper. And CBOT, the Chicago Board of Trade, deals with treasuries and various agricultural commodities. Now, what does this mean for you practically? It means robust regulation, transparent order matching, and genuine market depth. These exchanges are highly regulated entities. They must follow strict rules about order execution, reporting, and market integrity. This is why professional traders trust futures markets. There's genuine oversight and accountability. However, there is one small cost associated with this. To access real-time market data from these exchanges, you need to pay data fees. Now, don't let this put you off. They're actually quite reasonable. For a bundle covering the CME markets, you're looking at around $12 to $15 per month. If you only want access to specific markets, it can be as little as a few dollars. Through TradingView, for example, you can subscribe to CME Group futures data for about $5 monthly for non-professional traders. That's it, $5 for access to professional-grade real-time market data from a regulated exchange. Rather a bargain when you consider what you're getting: transparent pricing, genuine liquidity, and the confidence that you're trading in a properly regulated environment. So yes, there's a small data fee, but it's a tiny price to pay for the level of market integrity and professionalism you receive in return. Now, if you're coming from Forex, you're familiar with pips, those tiny little price increments. Well, in futures, we use different terminology, but the concept is similar. We talk about ticks and points. Let me break this down for you, because once you understand this, calculating your risk and reward becomes wonderfully straightforward. A tick is the smallest possible price movement in a futures contract. It's the minimum increment that price can move. A point, on the other hand, is a full unit of price movement. Now, the relationship between ticks and points varies depending on which market you're trading. Let's use the Nasdaq NQ as our example, because it's one of the most popular contracts. On the NQ mini contract, one full point is made up of 4 ticks. Each individual tick is worth $5. So if price moves from, say, 15,500 to 15,500.25, that's 1 tick, $5 of profit or loss per contract. If price moves a full point from 15,500 to 15,501, that's 4 ticks, which equals $20 per contract. The E-mini S&P 500 ES works similarly. 4 ticks make up 1 point, but ES moves larger amounts per tick because it's tracking a larger index. 1 tick on ES is worth $12.50, so a full point is worth $50 per contract. Now here's where it gets interesting with different markets. The Russell 2000 RTY moves in tenths rather than quarters. So 1 point equals 10 ticks, and each tick is worth $5, making a full point worth $50. Why is this important? Because it makes risk calculation incredibly simple. If you're trading NQ with a 25-point stop loss, you instantly know that's $500 of risk per contract, 25 times 20. No complex calculations, no confusion about position sizing. It's beautifully straightforward. Compare this to Forex, where you have to calculate pip values that vary depending on your position size and the pair you're trading. With futures, once you know the dollar value per point for your chosen market, your risk calculation is just simple multiplication. Brilliant, really. Right. Let's get specific about contract values for the mini contracts. These are what we call the standard size futures contracts that most active traders use. Understanding these values is absolutely crucial for managing your risk properly. The E-mini S&P 500, ticker ES, is worth $50 per point. Each tick, remember, is a quarter point, so that's $12.50 per tick. This is the most heavily traded futures contract in the world, and for good reason. It offers excellent liquidity and represents the broad U.S. equity market. The E-mini Nasdaq 100, ticker NQ, this is the scalper's favorite. It moves $20 per point, with each tick worth $5. Now, NQ tends to be more volatile than ES, which is why scalpers love it. You get more point movement within similar timeframes, which creates more opportunities for quick trades. The E-mini Dow Jones, ticker YM, is a bit different. It's worth $5 per point, and interestingly, it moves in 1-point increments, no fractional ticks. So each tick is a full point worth $5. The Dow tends to move in a more measured way compared to the Nasdaq. And finally, we have the E-mini Russell 2000, ticker RTY. This tracks small-cap American companies and is worth $50 per point, the same as ES. But remember, it moves in 10th-point increments, so each tick is $5. Now, why does this matter so much? Because when you're calculating your position size and risk, you need to know exactly how much each point of movement is worth. If you set a stop loss 10 points away on ES, that's $500 of risk per contract. On NQ, that same 10-point stop is $200. On YM, it's just $50. This variability means you can choose the market that best fits your account size and risk tolerance. Got a smaller account? Perhaps YM or the micros would be more suitable. Got more capital and want faster movement? NQ might be your instrument of choice. It's all about matching the contract size to your trading capital and style. Now, here's something absolutely brilliant that the exchanges introduced: micro contracts. These are exactly what they sound like: smaller versions of the standard mini contracts, specifically designed for traders with smaller accounts or those who want more precise position sizing. Micro contracts are 1/10 the size of their mini counterparts. Let me show you what this means practically. The Micro E-mini S&P 500 ticker MES is worth $5 per point instead of 50. That's exactly 1/10 of the ES contract. Each tick is worth $1.25 instead of $12.50. The Micro E-mini Nasdaq, ticker MNQ, moves $2 per point instead of 20. Each tick is worth 50 cents. This is absolutely perfect for beginners who want to learn to trade the Nasdaq without risking the full $20 per point that the standard NQ contract demands. The Micro E-mini Dow, ticker MYM, is worth 50 cents per point compared to $5 on the standard YM. And the Micro E-mini Russell 2000 ticker M2K is $5 per point with each tick worth 50 cents for every 10th point movement. Now, you might be thinking, why would I bother with micros if I can trade the minis? Well, let me give you several excellent reasons. First, if you're starting with a smaller account, say $1,000 to $5,000, micros allow you to trade with proper risk management without over-leveraging. You can risk an appropriate percentage of your account without needing massive stop losses in dollar terms. Second, micros give you flexibility in scaling your positions. If your strategy calls for a stop loss that would require, say, 3 contracts worth of risk, but you only have enough capital for 2 full minis, you could trade 1 mini and 10 micros to get the exact exposure you need. Third, and this is important for learning, micros let you trade real money in real market conditions without the pressure of $20 ticks adding up against you while you're still developing your skills. You get genuine market experience with lower financial pressure. The beauty of the micro contracts is that they move identically to the minis. Same charts, same price action, same everything, just scaled down in dollar value. It's like having a volume knob on your risk exposure. Absolutely brilliant innovation for retail traders. Right, let's compare the two most popular index futures, ES and NQ. These are the instruments most day traders focus on, but they have quite different personalities. Understanding these differences will help you choose which one suits your trading style better. The E-mini S&P 500 ES is the heavyweight champion of futures trading. It's the most traded futures contract on the planet, and for good reason. ES tends to move in a more measured, smooth fashion. It represents 500 large-cap companies, so it's essentially tracking the broad US equity market. This makes it perfect for traders targeting medium to larger moves. If you're looking to capture 20, 30, 50-point swings during the day, ES is absolutely brilliant for that. The E-mini Nasdaq 100 NQ, on the other hand, is what I like to call the scalper's paradise. Because it's weighted heavily toward technology companies, it tends to be considerably more volatile. During the market open, a 20-second candle on NQ can have an average range of around 9 points. That's $180 on just one contract. The same time frame on ES might only move 3 or 4 points. Here's a fascinating thing. If you look at charts of ES and NQ side by side, you'll notice they often move in a very similar structural pattern. They tend to respect similar levels, form similar patterns, and move in correlation with each other. But, and this is crucial, NQ moves more within those structures. For example, You might see a bullish impulse that moves ES up 30 points and NQ up 110 points. Structurally, it's the same move, but NQ gives you far more points, and therefore more dollar value, from the same market structure. This is why NQ is so popular with scalpers. There are simply more short-term opportunities because price moves more quickly. However, occasionally, they do deviate. You might see ES bounce off a previous low, while NQ crashes right through it. These deviations can actually create interesting trading opportunities if you understand the relationship between them. So which should you trade? Well, if you're a scalper who likes quick in and out trades and can handle the faster pace, NQ is probably your instrument. If you prefer medium-term swing trades with smoother price action and slightly less volatility, ES might suit you better. Many traders actually watch both and trade whichever is setting up better on any given day. The key is understanding the character of each market and matching it to your style. Now, let's discuss something absolutely fundamental to understanding futures trading: leverage and notional value. This is where many newcomers get a bit confused, so let's break it down carefully. When you trade a futures contract, you're not paying for the full value of what you're controlling. Instead, you're putting up what we call margin, a deposit essentially, that allows you to control a much larger position. The full value of that position is what we call the notional value. Let me give you a concrete example with the E-mini S&P 500. Each ES contract represents 50 times the value of the S&P 500 index. So if the S&P is trading at 4,000, the notional value of one ES contract is 4,000 multiplied by 50, that's $200,000. You're controlling a $200,000 position. Now, you're not required to have $200,000 in your account to trade this contract. That's where leverage comes in. With a discount broker, you might only need $500 of day trading margin to control that position. That's leverage of 400 to 1. With $500, you're controlling $200,000 worth of market exposure. The Nasdaq is even larger. If NQ is trading at 15,000, and each contract represents 20 times the index value, that's a notional value of $300,000 per contract. Yet you might only need $1,000 or so in day trading margin to control it. Now this is where the double-edged sword comes in. This leverage magnifies both your gains and your losses. If the S&P moves 1%, which is a fairly common daily move, that's a $2,000 swing on one ES contract. If you only have $500 in your account, a 1% adverse move would completely wipe you out and then some. This is why understanding notional value is so crucial. You need to respect the fact that you're controlling positions worth hundreds of thousands of dollars. Just because you only need $500 or $1,000 in margin doesn't mean this is a small position. The leverage is giving you enormous market exposure. Professional traders think in terms of notional value, not just margin requirements. They understand the true size of their positions and manage risk accordingly. This is what separates successful futures traders from those who blow up their accounts in the first week. You must respect the leverage, understand the notional exposure, and size your positions appropriately for your account size. Margin, initial, maintenance, intraday. Understanding margin requirements is essential for futures trading, as different margin types apply depending on your trading style and time horizon. Initial margin. This is the deposit required to open and hold a position overnight. It's the full regulatory margin set by the exchange and represents the maximum capital you need to lock up for multi-day positions. For example, one ES mini contract might require $5,000 in initial margin to hold overnight. Maintenance margin. This is the minimum account balance required to keep a position open. If your account falls below maintenance margin due to losses, you'll receive a margin call requiring you to deposit additional funds or close positions. Maintenance margin is typically about 80 to 90% of initial margin. Intraday margin, also called day trading margin. This is a reduced margin requirement offered by many brokers for positions opened and closed within the same trading day. Intraday margins can be as low as 25% of initial margin, sometimes even lower with specialized day trading brokers. For instance, while an ES Mini requires $5,000 overnight, you might only need $500 to $1,000 for intraday trading. This is why futures are particularly attractive for day traders. The significantly reduced intraday margin allows you to control the same contract size with much less capital as long as you close positions before the trading day ends. Always verify your broker-specific margin requirements, as they can vary between brokers and may change based on market volatility. Understanding these margin types helps you plan your capital allocation and trading strategy effectively. Let's look at traditional brokers and their margin requirements. By traditional brokers, I'm referring to well-established firms like Interactive Brokers, TD Ameritrade, Charles Schwab, the big institutional-grade brokerages. These firms typically set higher margin requirements than discount brokers, and there's actually good reason for this. They're providing more cushion to protect newer traders from over-leveraging and getting into financial trouble. Think of it as training wheels of sorts. For the E-mini S&P 500, you might see initial margin requirements around $10,000 to $12,000 per contract at these traditional brokers. For day trading, they might require anywhere from $2,000 to $5,000 per contract, still considerably higher than the discount brokers offer. Interactive Brokers, for instance, publishes their margin requirements quite transparently. You might see ES requiring around $12,000 for overnight positions and perhaps $3,000 to $4,000 for intraday. The Nasdaq, NQ, might require similar amounts, though it tends to have higher margin requirements due to its greater volatility. Now, you might be thinking, why would I choose a traditional broker with higher margins when I could use a discount broker? Well, there are several good reasons. First, if you're newer to futures, having those higher margin requirements actually forces you to trade smaller and reduces the temptation to over-leverage. It's protective. Second, traditional brokers often provide more comprehensive platforms, better customer service, more educational resources, and more robust risk management tools. Interactive Brokers, for example, has sophisticated risk analysis tools built into their platform. Third, and this matters for larger accounts, traditional brokers often have better connectivity, more reliable fills, and access to more advanced order types. If you're trading larger size or managing significant capital, these factors become quite important. The key point is this: higher margin requirements aren't necessarily bad. They force more conservative position sizing, which for most traders, especially those still learning, is actually beneficial. Yes, you'll need more capital to start, but you'll also be trading with more appropriate leverage for your skill level. As your account grows and your skills develop, those higher margin requirements become less of a constraint and more of a safety feature. Now let's examine discount brokers, firms like Tradeovate, which have become incredibly popular with retail day traders. These brokers offer significantly lower margin requirements, making futures accessible to traders with smaller accounts. With Tradeovate, for example, you might see ES day trading margin as low as $500 per contract. That's right, $500 to control a contract with a notional value of $200,000. The Nasdaq NQ might require around $1,000 for intraday margin. These dramatically lower requirements mean you can start trading futures with much less capital. For many retail traders, this is absolutely brilliant. It democratizes access to professional markets. You don't need $10,000 or $20,000 to start. You could potentially begin with just a few $1,000s in your account and trade the micros or even some mini contracts with proper risk management. However, and this is a very important however, these low margin requirements come with significant responsibility. You must be extraordinarily disciplined about risk management. The temptation to over-leverage is enormous when you can control such large positions with relatively little capital. Let me paint you a scenario. Say you have $2,000 in your account with Tradeovate. At $500 per contract, you could theoretically open 4 ES contracts. But if each contract moves against you by just 10 points, that's $500 per contract, you'd lose $2,000, your entire account, in minutes. This is why over-leveraging is the #1 killer of retail futures accounts. Those low margin requirements aren't an invitation to trade maximum size. They're a tool that, when used responsibly, allows you to trade appropriate size for your strategy while keeping capital requirements reasonable. My strong recommendation: never risk more than 1 to 2% of your account on a single trade, regardless of how low your broker's margin requirements are. If your stop loss would risk more than that percentage, trade micros instead of minis, or reduce your position size. Remember, the margin requirement is the minimum your broker needs, not the amount you should actually have. You need substantial cushion beyond that minimum to handle normal market fluctuations without getting automatically liquidated. Professional traders typically have 5 to 10 times the minimum margin requirement in their accounts. That's the level of capitalization you should aspire to for comfortable, low-stress trading. Let's work through a practical risk calculation example using the NQ mini contract. This is absolutely essential. If you can't calculate your risk accurately, you're trading blind. Here's our scenario. You're trading one NQ mini contract, and your strategy calls for a 25-point stop loss. How much are you risking? Remember, NQ moves $20 per point, so the calculation is beautifully simple. 25 points times $20 equals $500 of risk per contract. Now, let's say you're targeting a 1.5 to 1 reward to risk ratio. Your stop is 25 points, so your target will be 25 times 1.5, which equals 37.5 points. At $20 per point, that's $750 of potential profit per contract. See how straightforward this is? This is one of the beautiful aspects of futures trading. Unlike Forex, where pip values change depending on your lot size and the currency pair, or stocks where you need to calculate based on share price and quantity, futures give you a fixed dollar amount per point. Once you know that number, risk calculations are just simple multiplication. Let's expand this example. Suppose you have a $10,000 account and you want to risk 1% per trade. 1% of $10,000 is $100. But wait, our NQ trade with a 25-point stop risks $500 per contract. That's 5% of your account on a single trade. Much too high for proper risk management. This is where micros become essential. If you traded MNQ instead, the micro NASDAQ at $2 per point, that same 25-point stop would risk just $50. Now you could actually trade 2 micro contracts and risk $100 total, staying within your 1% risk rule. Alternatively, if you insist on trading the mini NQ, you'd need a $5,000 account to risk just 1% with that 25-point stop. Or you could tighten your stop to 5 points, which would risk $100 on one mini contract. But that tighter stop might not give your trade enough room to breathe. This is why understanding these calculations is so crucial. They determine whether you can trade a particular instrument with your current account size, or whether you need to trade micros, reduce position size, or wait until your account grows larger. Professional trading isn't about taking the biggest positions you can afford. It's about taking appropriately sized positions that allow you to trade consistently without excessive risk. Now let's work through account sizing requirements for trading ES minis. This is crucial for determining whether you have sufficient capital to trade this instrument responsibly. Let's start with our parameters. You're trading the E-mini S&P 500 ES, which moves $50 per point. Your strategy typically uses an 8-point stop loss. So, what's your risk per contract? 8 points times $50 equals $400 per contract. Now, the question becomes, how large does your account need to be to trade this with proper risk management? This depends on what percentage of your account you're willing to risk per trade. If you follow the 5% risk rule, which some shorter-term traders use, you take that $400 risk per contract and divide it by 0.05. That gives you $8,000. So with an $8,000 account, risking 5% per trade, you could take one ES contract with your 8-point stop. However, many professional traders recommend the more conservative 1% risk rule. In that case, you divide $400 by 0.01, which gives you $40,000. That's right, you'd need a $40,000 account to properly trade one ES mini contract with an 8-point stop while risking only 1% of your capital. Now, I can hear you thinking, $40,000 just to trade one contract? That seems excessive. But remember, we're talking about controlling a notional position worth over $200,000. The 1% rule ensures that even a string of losing trades won't devastate your account. Consider this. With $40,000 and 1% risk, you could lose 10 trades in a row and only be down 10% of your account. You'd still have $36,000 and plenty of capital to continue trading. If you were risking 5% per trade, those same 10 losses would cut your account in half. But what if you don't have $40,000? Does this mean you can't trade ES? Not necessarily. You have several options. First, you could trade the MES, micro ES, which is 1/10 the size. Second, you could use a wider stop loss if your strategy allows, though that increases your dollar risk per contract. Third, you could trade with a 5% rule, understanding that you're taking on more risk. Or fourth, and this is often the best option, you could trade through a prop firm, giving you access to larger capital without risking your own money. The key takeaway: professional account sizing isn't about trading the maximum position you can technically afford based on margin requirements. It's about trading positions small enough that you can weather normal losing streaks without catastrophic damage to your capital. Let's work through account sizing for micro contracts using MNQ, the Micro E-mini Nasdaq, as our example. This is where futures trading becomes truly accessible for retail traders with smaller accounts. Remember, MNQ moves just $2 per point. That's 1/10 of the regular NQ contract. Let's say your strategy uses a 25-point stop loss. Your risk per contract is 25 points times $2, which equals $50 per contract. Much more manageable than the $500 you'd risk on a mini NQ. Now, applying the 5% risk rule, if you're risking $50 per trade, divide that by 0.05, and you get $1,000. So with a $1,000 account, you could trade one MNQ contract with a 25-point stop while risking 5% of your capital. Using the more conservative 1% risk rule, $50 divided by 0.01 gives you $5,000. So you'd need a $5,000 account to trade one MNQ with a 25-point stop while risking just 1% per trade. Compare this to the mini NQ requirements we discussed earlier, where you'd need $10,000 for the 5% rule or $50,000 for the 1% rule. Micros make futures trading dramatically more accessible. But here's where it gets even better. Micros allow you to scale your position size more precisely. Say you have a $2,500 account and want to risk 1% per trade. 1% of $2,500 is $25. At $50 risk per MNQ contract, you can't quite afford one full contract while staying within your 1% rule. However, you could either tighten your stop to 12 or 13 points, bringing your risk down to around $25 per contract, or you could be slightly more aggressive and trade one contract knowing you're risking closer to 2%. The flexibility is brilliant. Now, as your account grows, you can add more micro contracts. With a $10,000 account, you could trade 4 MNQ contracts with your 25-point stop and still only risk 2% total. That's $200 at risk for $800 potential reward at a 1-to-4 risk-reward ratio. This scalability is precisely why micros are so valuable. They allow you to start small, prove your strategy, build your account, and gradually increase position size as your capital grows. You're not stuck waiting until you have tens of thousands of dollars to start trading professional markets. You can begin with a few thousand, trade responsibly, learn the markets, and scale up as you demonstrate consistent profitability. This is how smart retail traders build their futures careers, starting with appropriate position sizes in micros, developing their skills, and gradually transitioning to larger positions as both their capital and competence grow. Now, let's explore one of the most brilliant aspects of micro contracts, their ability to give you precise position sizing control. This is where micros really shine compared to minis. Imagine you're trading NQ, and your strategy calls for a 25-point stop loss. With one mini NQ contract at $20 per point, that's $500 of risk. But what if your risk management plan only allows for $200 risk on this particular trade? With mini contracts alone, you're stuck. You either take the full $500 risk, or you don't trade at all. This is precisely where micros solve the problem beautifully. Remember, MNQ moves $2 per point, exactly 1/10 of the mini. So that same 25-point stop on MNQ risks only $50 per contract. If you want to risk $200 total, you simply trade 4 MNQ contracts. Problem solved. Here's another scenario. Perhaps you have $5,000 in your account, and you're willing to risk 2%, which is $100. A mini NQ with a 25-point stop risks $500, far too much. But 2 MNQ contracts with that same stop risk exactly $100. Perfect position sizing. This scaling flexibility extends beyond just matching risk targets. You can also use micros to add to or reduce positions incrementally. Say you're in a trade with one NQ mini contract and it's moving in your favor. You want to add to your position, but adding another full mini doubles your exposure, perhaps more than you're comfortable with. Instead, you could add 2 or 3 MNQ contracts, fine-tuning your exposure to exactly the level you want. The same principle works in reverse. If you need to scale out of a position partially, micros let you do so precisely. You might close half your position by exiting 5 of your 10 MNQ contracts, something you couldn't do as precisely with minis. This is also brilliant for transitioning between micros and minis as your account grows. Say you start with a smaller account, trading 6 MNQ contracts. As your account grows, you might transition to 1 NQ mini plus 6 MNQ, giving you exposure equivalent to 1.6 mini contracts. Later, 2 minis plus 6 micros equals 2.6 mini equivalents. You can scale up smoothly rather than in large jumps. The key insight is this: don't think of micros as just smaller contracts for smaller accounts. Think of them as precision instruments that allow you to dial in your exact desired exposure, regardless of your account size. Professional traders understand that proper position sizing isn't about trading the maximum you can afford. It's about trading the exact amount your strategy and risk management plan call for. Micros give you that precision. Right. Let's discuss contract expirations, something that often confuses newcomers, but is actually quite straightforward once you understand the system. Futures contracts don't last forever. They have expiration dates, after which they settle and a new contract begins trading. For equity index futures, like ES and NQ, contracts expire quarterly, 4 times per year. The 4 quarterly expiration months follow a specific code system that you absolutely must know. March contracts are coded with the letter H. June contracts use M. September contracts use U. And December contracts use Z. If you remember nothing else, remember H, M, U, Z. That's your quarterly cycle. So when you see NQZ 2025, that means the Nasdaq 100 futures contract expiring in December 2025. ESH 2026 would be the S&P 500 contract expiring in March 2026. Simple once you know the codes. These contracts typically expire on the 3rd Friday of the delivery month. For example, the December 2025 contract would expire on the 3rd Friday of December 2025. Mark these dates in your calendar because you absolutely do not want to be holding a contract through expiration. Now, you might be wondering, what happens if I do hold through expiration? For equity index futures, they're cash settled, meaning you won't have anything physically delivered to your door. But the contract will be automatically closed at the settlement price, and depending on where you were in the trade, you might take a loss or gain. More importantly, as we'll discuss in the next section, liquidity dries up in expiring contracts, making them increasingly difficult to trade. The front month, the contract closest to expiration, is always where the action is. This is where all the volume and liquidity concentrates. As we get closer to expiration, traders and institutions gradually roll their positions to the next quarterly contract, and you need to do the same. For day traders, you're probably not thinking much about expiration because you're closing your positions each day anyway. But even as a day trader, you need to trade the front month contract to ensure you have the best liquidity and tightest spreads. For swing traders or anyone holding positions overnight, tracking expiration dates becomes crucial. You'll need to roll your positions to the next contract before the current one expires, and we'll discuss exactly how and when to do that next. Now, let's discuss the rollover process when you transition from the expiring contract to the next one. This is crucial knowledge that can save you from some rather unpleasant trading experiences. Contract rollover happens when the current front-month contract is approaching expiration, and traders need to move their positions to the next quarterly contract. This isn't optional if you want to continue trading with good liquidity and reliable price action. The key thing to understand is that volume and liquidity don't wait until expiration date to shift. They start migrating well before that. Typically, about a week before expiration, you'll notice trading volume beginning to move from the expiring contract to the next one. By 3 to 4 days before expiration, the shift becomes quite pronounced. Here's what happens practically. Say the December NQ contract expires on the 3rd Friday of December. By the Monday or Tuesday of that week, you'll notice the March contract starting to see much heavier volume. The December contract's volume drops off, spreads widen, and price action becomes choppy and unreliable. My recommendation: roll your positions by the Wednesday before expiration at the absolute latest. Many professional traders actually roll a full week early to avoid any issues. Yes, there's typically a small price difference between the expiring contract and the next one, what we call roll spread, but that's just part of trading futures. The cost of that small spread is far less than the headaches of trying to trade a contract with degrading liquidity. How do you actually execute the roll? It's quite simple. You close your position in the current contract and immediately open the same position in the next contract. If you're long 2 ES December contracts, you sell those 2 and buy 2 ES March contracts. Most platforms allow you to do this as a single order called a calendar spread, which can often get you a better fill. The critical mistake traders make is ignoring the rollover and continuing to trade the dying contract. Suddenly, their stop losses aren't getting filled where expected, their entries are slipping, and price isn't moving in the nice clean patterns they're used to. That's because all the institutional flow and professional traders have already moved to the new contract. Keep a calendar noting your contract expiration dates. Set reminders for 1 week prior. When that reminder goes off, check the volume comparison between the current and next contract. If the next contract is showing comparable or greater volume, that's your signal to roll. Don't wait until the last minute. Trade where the liquidity is, and the liquidity moves to the new contract well before expiration. Identify the front month CME method. Finding the most active contract is crucial for ensuring optimal liquidity and tight spreads when trading futures. The front month is the futures contract with the highest trading volume and open interest. This is the contract that professional traders focus on because it offers the best liquidity, tightest spreads, and most reliable price action. To identify the front month on the CME website, follow these simple steps. Step 1. Visit the CME Group website at cmegroup.com. Step 2. Navigate to the Market section and select your instrument. For example, if you want to trade the E-mini S&P 500, select ES. Step 3. Look at the contract listings. The CME website displays all available contracts with their expiration dates and trading volumes. Step 4. Identify the contract with the highest volume. This is typically shown in the volume column. The contract with significantly higher volume than others is your front month. Step 5. Note the contract code. For example, ESH25 represents the ES contract expiring in March 2025, where H represents March in the futures month code system. As a general rule, the front month is usually the nearest quarterly expiration. However, always verify by checking volume, as sometimes the next quarter's contract may already have higher volume as traders begin rolling their positions. Trading the front month ensures you have sufficient liquidity for smooth entries and exits, minimal slippage, and the most accurate price discovery. Never trade distant contracts with low volume, as this can result in poor fills and increased costs. Now, let's discuss trading hours for futures markets. One of the significant advantages that futures offers compared to traditional stock markets. Futures markets operate nearly around the clock, 5 days per week. The trading week begins on Sunday evening at 6 p.m. Eastern Time and runs continuously through Friday evening at 5 p.m. Eastern Time. That's 23 hours per day, 5 days per week. Quite remarkable, really. There is one brief maintenance break each day from 5 p.m. to 6 p.m. Eastern Time. During this hour, the markets pause for settlement and system maintenance. No trading occurs during this period, so you won't be able to enter or exit positions. Mark this in your planning. If you're holding a position into this maintenance window, you'll need to wait until 6 p.m. for markets to reopen. This extended trading schedule is tremendously beneficial for several reasons. First, it allows you to react to global events and economic news that occur outside regular U.S. market hours. If significant news breaks in Asia or Europe overnight, you can respond immediately rather than waiting for the U.S. session to open. Second, it provides flexibility for traders around the world. Whether you're in London, Sydney, Tokyo, or New York, there are active trading hours that fit your time zone. You're not constrained to only trading during the American business day. Third, for those of you who have full-time jobs, futures trading hours mean you can trade in the evening after work without sacrificing your career. Many retail traders successfully trade the evening or early morning sessions. However, and this is important, not all hours are created equal in terms of volume and liquidity. The most active trading period is during U.S. regular trading hours. That's 9:30 a.m. to 4 p.m. Eastern Time, when the US stock market is open. During RTH, you'll see the highest volume, tightest spreads, and most reliable price action. Outside these hours, during what we call the overnight session or Globex session, volume is typically lower. This doesn't mean you can't trade profitably during these times. Many traders do, but you should adjust your position size and expectations accordingly. Lower volume means wider spreads and occasionally less reliable fills. For day traders, particularly scalpers, I strongly recommend focusing on the regular trading hours unless you're specifically developing a strategy for overnight trading. The increased liquidity during RTH makes your technical analysis more reliable and your executions more predictable. Mark these hours in your calendar. Sunday, 6 p.m. ET market open. Daily maintenance 5 to 6 p.m. ET. Friday, 5 p.m. ET market close. Understanding when markets are most active and when they pause is essential for effective futures trading. Now, we need to discuss something absolutely critical, and I cannot stress this strongly enough: major economic news events and how to handle them. This is where many traders, even experienced ones, make catastrophic mistakes. When high-impact economic data is released, things like consumer price index, non-farm payroll numbers, Federal Reserve announcements, GDP reports, the futures markets can experience extreme, violent volatility within seconds. I'm not talking about normal price movement. I'm talking about the market plummeting or skyrocketing 50, 100, even 200 points on NQ in the blink of an eye. Here's what typically happens. Algorithms instantly parse the economic data the moment it's released. Within microseconds, faster than any human can react, these algorithms are entering massive orders. The market gaps, spreads widen dramatically, and price action becomes completely erratic as the market tries to find equilibrium with the new information. If you're holding a position during one of these releases, several dreadful things can happen. First, your stop loss might not get filled where you expect. In extreme volatility, prices can gap right through your stop, filling you 10, 20, 50 points worse than your stop loss level. That $500 planned loss suddenly becomes a $2,000 actual loss. Second, spreads can widen from 1 tick to 5 or 10 ticks. That nice tight bid-ask spread you're used to? Gone. You might see ES spreads jump from 25 cents to several dollars in those volatile seconds. Third, and perhaps most treacherous, the initial market reaction is often not the final reaction. Price might spike one direction, trigger stops, then completely reverse, and spike the other way. Traders who try to trade the news often get whipsawed, stopped out in the initial move, then watching helplessly as price runs back in their original direction. My very strong recommendation, and this is what professional traders do, is to avoid having open positions within at least 5 to 10 minutes on either side of major economic releases. Check Forex Factory or another economic calendar daily. Note when high-impact events are scheduled, they're marked with red folders or high-impact indicators. The most common problematic release times are 8:30 a.m. Eastern Time. That's when most U.S. economic data drops, and 2 p.m. Eastern for Fed announcements. If there's a red folder event at 8:30, be flat by 8:25 at the latest. Don't re-enter until 8:35 or 8:40, once the initial chaos has settled and spreads have normalized. Some traders, usually those with significant experience and very tight risk management, do trade news events deliberately. But they use specific strategies designed for that environment. They trade with tiny position sizes, and they accept that it's essentially a coin flip. For most traders, especially those still developing their skills, news events are simply not worth the risk. Trust me on this. You will not miss anything worthwhile by sitting out for 15 minutes during major news releases. The opportunity cost of missing a potential trade is nothing compared to the very real cost of getting stopped out at horrific levels or experiencing massive slippage. Protect your capital, stay flat during major news events. Let's consolidate the major benefits of trading futures, why so many professional traders choose this market over other instruments. First and foremost, you're trading on a centralized, regulated exchange. The CME Group and other futures exchanges operate under strict regulatory oversight. This means transparent order matching, genuine market depth, and real liquidity. Every trade you see on the tape actually happened. There's no simulation, no synthetic liquidity. When you see volume of 200,000 contracts traded on ES, those are real trades from real participants. This transparency gives you confidence that you're seeing genuine market activity. Second, the spreads in futures are remarkably tight and reliable. On major contracts, like ES and NQ, during regular trading hours, you'll typically see a one-tick spread. That's it. 25 cents on ES, a quarter point on NQ. And here's the brilliant part. These spreads don't widen when you need them to stay tight. Unlike Forex, where your spread can balloon during news or volatile periods, futures spreads remain consistently narrow. This is absolutely critical for scalpers and short-term traders. Third, execution is fast and fills are reliable. Because you're trading on a centralized exchange with deep liquidity, your orders get filled at or very near your expected price. Slippage is minimal under normal conditions. When you click buy at 15,500, you'll most likely get filled at 15,500, not 15,502 or 15,505. This predictability allows you to calculate your risk accurately and trade with confidence. Fourth, the dollar per point structure makes risk calculation beautifully simple. You instantly know that 1 point on NQ is $20, 1 point on ES is $50. No calculating pip values that change with lot sizes, no confusion about position sizing. Simple multiplication, that's all you need. If you're risking 25 points on NQ, it's $500 per contract. Elementary mathematics. Fifth, for US-based traders, there's a significant tax advantage. Under Section 1256 of the tax code, futures profits receive favorable treatment, 60% taxed at long-term capital gains rates, 40% at short-term rates. This blended rate can save you thousands of dollars compared to Forex or stock trading, where all short-term profits are taxed as ordinary income. Sixth, the market structure is professional and institutional. When you trade futures, you're in the same market as hedge funds, banks, prop trading firms, and sophisticated institutions. You're seeing the same prices, the same order flow, the same opportunities. This creates more reliable technical patterns and more consistent market behavior. Finally, futures markets are highly liquid with deep order books. If you want to trade 10 contracts, 20 contracts, even 50 or 100 contracts, there's sufficient liquidity to fill your orders without moving the market. This scalability means futures can accommodate your trading as your account grows, from micro contracts all the way up to institutional-sized positions. These benefits combined create what I believe to be the optimal environment for serious professional retail trading. Once you experience the difference, particularly the tight spreads and reliable fills, it's quite difficult to go back to other instruments. Now, in fairness, let's discuss the challenges and potential drawbacks of futures trading. It's important to understand both sides before committing to this market. The first challenge is the fixed contract size structure. Unlike Forex, where you can trade any lot size you want, 0.01 lots, 0.37 lots, 1.5 lots, futures come in fixed contract increments. You can trade 1 ES contract or 2 ES contracts, but you can't trade 1.3 contracts. This lack of fractional position sizing can make it challenging to match your exact desired risk, particularly with mini contracts. Now, this is where micros help tremendously, as we discussed earlier. But it's still more restrictive than the infinite granularity you get with Forex position sizing. You need to work within the contract structure, scaling your position using combinations of minis and micros to approximate your target exposure. Second, there are commissions to consider. Futures brokers charge a per-contract commission, typically ranging from $1 to $5 per side, depending on your broker and the contract you're trading. Trade of 8, for example, charges about $1.29 per side on NQ, so that's $2.58 round turn for one contract. While these fees are quite reasonable, considering what you're getting, they do add up if you're taking many trades per day. For comparison, many Forex brokers advertise zero commission trading, though they're making their money through wider spreads instead. With futures, the cost is transparent and fixed. You know exactly what you're paying. Still, active scalpers need to factor these commissions into their strategy and ensure their win rate and average win size can overcome the transaction costs. Third, as we discussed earlier, you need to pay for real-time market data. That CME Group data subscription costs about $5 to $15 per month. Not a fortune, certainly, but it's an ongoing cost that Forex traders don't typically encounter. This is the price of accessing professional-grade exchange-traded data rather than broker-simulated prices. Fourth, margin requirements can be substantial, particularly at traditional brokers. Even with discount brokers offering lower intraday margins, you still need several $1,000s minimum to trade safely with proper risk management. This higher capital requirement can be a barrier for traders just starting out, though prop firms do provide a solution to this challenge. Fifth, the leverage in futures is significant, which, as we've discussed, is a double-edged sword. While it allows you to control large positions with relatively small capital, it also means you can lose money very quickly if you're not disciplined. New traders coming from less leveraged instruments sometimes underestimate how fast losses can accumulate in futures. Sixth, contract rollovers require attention and action. Every quarter, you need to remember to roll your positions to the new contract. Miss this, and you'll find yourself trading a contract with terrible liquidity and unreliable price action. It's not difficult, it just requires awareness and calendar management. Finally, the learning curve for understanding futures mechanics, ticks, points, contract months, notional value, different margin types can initially seem overwhelming compared to simpler instruments. There's more terminology to learn, more moving parts to understand. However, I would argue that these challenges are quite manageable and pale in comparison to the benefits. The fixed contract sizes become second nature once you understand scaling with micros. Commissions are transparent and reasonable. Data fees are minimal. Higher capital requirements can be addressed through prop firms, and the learning curve, while initially steeper, results in understanding a more professional, more reliable market structure. The key is approaching futures with proper education, adequate capitalization, and realistic expectations. Understand these challenges going in, plan for them, and they become merely factors to manage rather than insurmountable obstacles. Right. Let's discuss the various brokers and platforms available for futures trading. Choosing the right combination of broker and platform is quite important for your trading experience. Starting with platforms, these are the actual software applications where you'll chart, analyze, and execute trades. The most popular futures trading platform is NinjaTrader. It's completely free to use for charting and market analysis, and it doubles as a broker as well. NinjaTrader offers sophisticated charting tools, advanced order types, automated trading capabilities, and a large ecosystem of third-party add-ons. Many professional futures traders use NinjaTrader as their primary platform. TradeOvate is another excellent option that's gained tremendous popularity with retail traders. It offers browser-based, desktop, and mobile applications, quite convenient if you trade from multiple devices. TradeOvate is also a broker, which makes setup straightforward. Their platform is intuitive, modern, and well-suited for both beginners and experienced traders. Then there's TradingView, which many of you might already use for charting. TradingView allows you to connect to various futures brokers and trade directly from your charts. This is brilliant because you get TradingView's superior charting and analysis tools combined with direct execution. I personally trade through TradingView, connected to my broker, and I find this approach quite efficient. Other platform options include TradeStation, another comprehensive platform with both charting and brokerage services, and TD Ameritrade's Thinkorswim platform, which some traders prefer for its analysis tools. Now, regarding brokers specifically, these are the firms that provide you access to the exchanges and hold your trading capital. TradeOvate and NinjaTrader, as mentioned, are both platforms and brokers. This integration is convenient. One account, one login, everything synchronized. Other notable brokers include Interactive Brokers, which is one of the largest and most established firms globally. They offer access to virtually every futures market worldwide, excellent execution, and competitive rates, though their platform interface is rather, shall we say, utilitarian. AMP Futures, Dorman Trading, StoneX, Iron Beam, and Optimus Futures are all reputable discount brokers offering competitive commissions and margin rates. Each has slightly different fee structures, platform integrations, and service levels. When choosing a broker, consider these factors: commission rates. What do they charge per contract? Margin requirements. Do they offer competitive intraday margins? Platform integration. Which platforms can you connect to? Customer service. How responsive are they when you have issues? Regulatory compliance. Are they properly registered with the NFA and CFTC? For most retail traders starting out, I'd recommend either TradeOvate or NinjaTrader. Both are beginner-friendly, offer competitive pricing, have excellent platforms, and provide good educational resources. If you prefer trading from TradingView charts, TradeOvate integrates seamlessly with TradingView. Don't be swayed solely by whoever offers the lowest commissions. A broker charging $1 per side with excellent fills and reliable technology is far better than one charging 50 cents per side with poor fills and platform crashes during volatile markets. Consider the complete package: platform quality, execution reliability, customer service, and yes, reasonable pricing. Most brokers offer demo accounts, so you can test their platforms before committing real capital. Take advantage of this. Spend a week or two paper trading on each platform you're considering. See which interface feels most intuitive, which execution speed feels best, which features you actually use. Then make your decision based on hands-on experience rather than just marketing materials. Now, let's walk through how to integrate TradingView with your futures broker. This is one of the most efficient setups for trading futures. TradingView has become tremendously popular among traders for good reason. It offers superior charting capabilities, an intuitive interface, excellent technical analysis tools, and the ability to trade directly from your charts. Many professional traders, myself included, prefer this integrated approach. First, you'll need to create a TradingView account if you don't already have one. Simply visit tradingview.com and sign up. The basic account is free, which gives you access to charting and analysis. However, for futures trading, you'll want to subscribe to real-time CME data. To subscribe to the data, go to your TradingView settings, find the section for market data subscriptions, and look for CME Group Futures. For non-professional traders, this costs about $5 per month. Click subscribe, enter your payment details, and you'll have immediate access to real-time futures data. This is essential. You cannot trade effectively with delayed data. Now, to connect your broker to TradingView, click on the Trading Panel button at the bottom of your chart. This will expand the trading interface. You'll see an option that says Connect Broker, or you might see a drop-down menu showing available brokers. If you're using TradeOvate, which integrates beautifully with TradingView, click See All Brokers, find the TradeOvate logo, and click on it. You'll be prompted to log in with your TradeOvate username and password. Once authenticated, your TradingView and TradeOvate accounts will be linked. The brilliant part about this integration is that you can now place trades directly from your TradingView charts. You don't need to switch between a charting platform and a separate execution platform. Everything happens in one interface, which is tremendously efficient. You can right-click on your chart to place limit orders, drag stop losses, and take profits visually on the chart. See your positions displayed graphically and execute market orders with one-click buttons. All your order management happens right there on the chart where you're doing your analysis. For those just starting out, TradingView also offers paper trading. This is a simulated trading environment that uses real market data but virtual money. It's perfect for practicing your strategy and getting comfortable with the platform before risking real capital. To access paper trading, simply select paper trading from the broker drop-down menu instead of your actual broker. Practice on paper trading for at least a few weeks. Learn how to place orders, manage positions, use the different order types, and navigate the interface. Once you're comfortable and confident, then connect your real broker account and begin trading with actual capital. The TradingView integration truly represents the modern standard for retail futures trading, professional-grade charting combined with seamless execution. Take the time to set it up properly and familiarize yourself with the interface. It's an investment that will pay dividends in your trading efficiency. Right. Once you've set up your platform and connected your broker, the next step is finding and loading the correct contract to trade. This is simpler than it might initially seem. In your trading platform, whether that's TradingView, NinjaTrader, or another platform, you'll need to search for your desired instrument under the Futures section. Let me walk you through this using TradingView as an example, but the process is similar across most platforms. At the top of your chart, you'll see a search box where you can type the symbol. Make sure you're on the Futures tab, not Stocks or Forex. Type in the basic ticker symbol for your instrument. For example, NQ for NASDAQ or ES for S&P 500. Now, This is where it gets important. You'll see a drop-down list showing various contract months. Remember, each quarterly contract has its own listing. You might see NQZ 2025, NQH 2026, NQM 2026, and so forth. As we discussed earlier, you want to trade the front month, the contract with the highest volume. For example, if December 2025 is the front month, you'd select NQZ 2025. That Z code means December, and 2025 is the year. Click on that contract, and it will load on your chart. However, there's an alternative approach that many traders prefer, using continuous contracts. Instead of searching for NQZ 2025, you can search for NQ1 with an exclamation mark. That's NQ1. The exclamation mark designates it as a continuous contract. The continuous contract automatically tracks the front month for you. As volume shifts from December to March, the continuous contract will automatically show you the March data. This is brilliant for longer-term chart analysis because you get an uninterrupted price history without gaps between contract months. However, and this is crucial, when you're actually placing trades, you need to verify which specific contract month you're trading. The continuous contract is excellent for charting and analysis, but your actual orders must be placed on the specific front month contract. Most platforms will show you which contract you're currently trading in the trading panel. Double-check this before placing any orders. You don't want to accidentally place an order on an expiring contract with low volume. Also, before you start trading any new instrument, verify the volume and liquidity. On your chart, or in your market depth tool, check that you're seeing substantial trading volume, thousands of contracts trading. If you see very low volume, you might be on the wrong contract month. A quick tip: many platforms allow you to create watch lists with your favorite instruments. Add both the continuous contract for charting and the specific front month contract for trading. This way, you can quickly switch between them and always know exactly what you're trading. Remember to update your watch list quarterly as contracts expire and new front months emerge. Set a calendar reminder for those third Fridays when contracts expire, so you're always trading the most liquid, active contract. Executing trades, market orders, and one-click trading. Fast execution is absolutely crucial in futures trading, and modern platforms provide multiple methods to enter and exit positions quickly. Let's start with market orders. A market order is the most common execution method. It's an instruction to buy or sell immediately at the best available price. When you submit a market order, you're guaranteed execution but not a specific price. Market orders execute instantly by taking liquidity from the order book. Now, let's discuss one-click trading. Most professional platforms offer one-click execution, allowing you to place market orders with a single mouse click directly from the chart or DOM, which stands for depth of market. This eliminates confirmation dialogues and reduces execution time to milliseconds. To enable one-click trading, you typically need to accept a risk disclosure in your platform settings. The benefits of one-click execution are significant. Speed matters tremendously when entering or exiting positions during fast market movements. You'll experience reduced slippage on entries and exits, and you gain the ability to react quickly to price action without navigating through order entry forms. However, traders must exercise caution with one-click trading. The lack of confirmation dialogues means accidental clicks can result in unintended positions. Always ensure your platform is configured correctly. Use appropriate position sizing and maintain discipline when executing trades rapidly. Understanding order execution is fundamental to successful futures trading. The difference between a profitable trade and a losing trade can often be just a few ticks. Let's discuss taking partial profits, a technique that's quite different in futures compared to Forex due to the contract-based structure. In Forex, you can close any fraction of your position you like. If you're long 1.5 standard lots, you can close 0.3 lots, 0.7 lots, any amount. It's infinitely divisible. Futures, however, work with whole contracts. This fundamental difference means you need to plan your partial profit strategy differently. Here's the key principle. You cannot take a partial profit if you're only trading one contract. One contract is the minimum unit, it's all or nothing. If you want to scale out of your position by taking partial profits, you must enter with multiple contracts. For example, let's say you want to take half your position off at your first target and let the remaining half run to a second target. In futures, This means you need to start with at least 2 contracts. When price reaches your first target, you close 1 contract, leaving 1 contract still running. How do you actually execute this? Quite simple, really. When you want to close part of your position, you place an opposite order for the number of contracts you want to close. If you're long 3 NQ contracts and want to take 1 contract off, you place a sell order for 1 contract. This closes 1, leaving you long 2 contracts. You can do this with limit orders or market orders, depending on your preference. Many traders place limit orders at their partial profit levels before the trade even begins. For instance, you might enter long with 3 contracts, immediately place a limit sell order for 1 contract at your first target, and another limit sell for 1 contract at your second target. This automates your scaling out process. Now, here's where micros become particularly valuable for partial profit strategies. Say you want very granular control over your exits. You might trade 10 MNQ contracts, allowing you to scale out by taking off 1, 2, or 3 contracts at various profit levels. This flexibility simply isn't possible if you're only trading 1 or 2 mini contracts. A common partial profit strategy might look like this. Enter with 4 contracts. At your first target, perhaps a 1-to-1 risk-reward, close 2 contracts, that's half your position, and you've now locked in a profit equal to your initial risk. Move your stop to break even on the remaining 2 contracts. At your second target, perhaps 1-to-2, close 1 more contract. Let the final contract run with a trailing stop, aiming for a larger move. This approach allows you to secure profits while still giving yourself upside potential. Even if that final contract gets stopped out at break-even, you've already secured profits from the first 3 contracts. However, remember that with every contract you trade comes a commission. If you're trading with TradeOvate at $1.29 per side, each contract you close costs $2.58 round turn in commissions. Trading 10 micros instead of 1 mini means 10 times the commissions. Factor this into your strategy. Is the granular control worth the additional commission cost? For some strategies, absolutely. For others, perhaps not. The key takeaway: plan your position sizing from the start based on your exit strategy. If you know you want to take partials, ensure you're entering with enough contracts to execute that plan. Don't enter with 1 contract hoping to scale out. It won't work. Think ahead, size appropriately, and use multiple contracts to implement sophisticated exit strategies. Let's cover the essential mechanics of position management in futures trading, understanding how to add to, reduce, and close positions properly. First and foremost principle: opposite side orders close contracts, while same side orders add to your position. This is fundamental to understanding futures execution. If you're currently long, meaning you've bought contracts, placing a sell order for the same quantity will close your position entirely. Buy 2 NQ, then sell 2 NQ, and you're flat, no position. Simple as that. However, if you're long 2 contracts and you buy 2 more, you're not closing anything, you're adding to your long position. Now you're long 4 contracts. Many beginners make the mistake of thinking buying when already long will somehow close them out. No, you're simply increasing your exposure. The same logic applies in reverse. If you're short, you've sold contracts, buying the same quantity closes you out, but selling more when already short adds to your short position. This might seem obvious once explained, but in the heat of trading, particularly when using one-click buttons, it's easy to click the wrong side. I've seen traders intend to close a long position, accidentally click buy instead of sell, and suddenly, they're long double their intended size. Disaster. This is why you must be absolutely clear on which button does what. Most platforms have a flatten or close all button. This is your emergency exit. 1 click and all positions are closed, all pending orders are canceled, everything's flat. During a crisis, or if you're confused about your position, hit that button. Better to be flat and reassess than to be unclear about your risk exposure. Now, let's discuss adding to positions, which is called scaling in, or pyramiding. Some traders enter their full position immediately. Others prefer to scale in, starting with perhaps 1 or 2 contracts, then adding more as the trade moves in their favor. If you're scaling in, you typically add contracts at predetermined levels. For example, you might buy 2 NQ at 15,500, then add 2 more at 15,510 if price continues up. The advantage is that you're building your position as it proves itself correct. The disadvantage is that your average entry price is higher than if you'd entered with full size initially. The critical rule for scaling in: only add to winning positions, never to losing ones. Adding to a losing position, what some traders call averaging down, is extremely dangerous. It dramatically increases your risk, and if you're wrong about the direction, you've just made a bad situation catastrophically worse. Regarding stop losses and take profits, these remain in place as working orders until either executed or cancelled. If you manually close your position with a market order, remember to cancel your working stop loss and take profit orders. Most platforms do this automatically, but verify this behavior with your specific platform. If you're scaling out of a position and taking partial profits, adjust your stop loss accordingly. If you started with 4 contracts and closed 2, your stop loss should ideally remain at the same price level, but now it's protecting 2 contracts instead of 4. Some platforms adjust this automatically, others require manual adjustment. Finally, always know your net position. At any moment, you should be able to state exactly, I'm long 3 ES contracts with a stop at X and target at Y. If you're ever uncertain about your position, stop trading, close everything, and start fresh. Confusion about your position size or direction is a recipe for disaster. Clear position management is the mark of a professional trader. Master these mechanics until they're second nature, and you'll avoid the embarrassing and costly mistakes that plague beginners. Now let's examine a crucial decision every futures trader faces. Should you trade with your personal capital or through a proprietary trading firm? Each approach has distinct advantages and considerations. Trading with personal capital gives you complete control and autonomy. Every penny of profit is yours. There's no profit split, no evaluation requirements, no rules to follow except your own risk management plan. You decide your position sizes, your trading hours, your strategies, everything. This freedom can be tremendously valuable, particularly for experienced traders with well-developed systems. However, personal capital trading requires substantial funds to trade safely. As we've discussed, proper risk management with mini contracts often requires tens of thousands of dollars. For many aspiring traders, accumulating that much trading capital while maintaining their lifestyle can take years. You're also assuming all the risk. Every losing trade comes directly from your pocket. Proprietary trading firms offer a fundamentally different model. You pay a relatively modest evaluation fee, typically ranging from $100 to a few $100s, and if you pass their challenge by demonstrating consistent profitability, they fund you with their capital. You then trade their money, and profits are split between you and the firm, usually in the range of 80 to 90% to you. The brilliant advantage here is that you're risking the firm's capital, not yours. If you have a losing day or week, it's their money at risk. If you blow the account, which happens, particularly when learning, you've only lost your evaluation fee, not your life savings. This risk transfer is enormously valuable for traders still developing their skills. Additionally, prop firms typically provide much larger capital than most retail traders could personally afford. Instead of trading 1 or 2 contracts with your own $5,000, you might be trading with $50,000 or $100,000 of the firm's capital, allowing for proper position sizing and meaningful profit potential. The trade-offs. First, there's the profit split. That 10 to 20% the firm takes can add up significantly as you become profitable. Second, you must follow their rules: maximum daily losses, maximum total drawdown, minimum trading days, sometimes restrictions on trading news or holding overnight. These rules protect the firm's capital but limit your flexibility. Third, there's typically a monthly fee to maintain your evaluation account. Unlike a one-time challenge fee, this recurring cost means that if you take several months to pass, the fees accumulate. Some firms waive this once you're funded, others continue charging monthly platform fees. So which should you choose? If you're just starting out with futures or transitioning from another market, prop firms offer a safer, more capital-efficient path to gaining experience. You can learn, make mistakes, and develop your edge without risking significant personal capital. Once you've demonstrated consistent profitability through a prop firm and accumulated profits, you might then transition to trading personal capital for that 100% profit retention. If you already have substantial trading capital, proven profitability, and a well-tested strategy, trading your own capital might make more sense. You keep all profits and trade with complete autonomy. Many successful traders actually do both. They trade personal capital for their primary income, while also trading prop firm accounts for additional exposure and profit streams. This diversified approach provides multiple income sources and risk management benefits. The key is being honest about where you are in your trading journey and choosing the path that best matches your current capital experience level and risk tolerance. Let's examine the specific prop firms available for futures trading and what differentiates them. The landscape has grown considerably, giving traders multiple options to choose from. TopStep is one of the oldest and most established futures prop firms. They offer various account sizes from $50,000 up to $150,000. Their evaluation typically requires you to hit a profit target. For example, $3,000 on a 50K account while staying within daily and total loss limits. Once you pass, you're moved to a funded account with an 80 to 90% profit split. TopStep has paid out millions to traders and has a solid reputation in the industry. Apex Trader Funding has become tremendously popular recently. They offer very trader-friendly rules. No minimum trading days requirement, meaning you can pass your evaluation in just a few trading sessions if you hit the profit target quickly. They also allow news trading on some account types and offer various account sizes up to $300,000. Their profit splits are quite generous, often starting at 90%. OneUp differentiates itself with unique features like the swing account, which is designed for traders who hold positions overnight or for several days. Many prop firms discourage or prohibit overnight holds, but OneUp specifically caters to swing traders. They also have quite reasonable evaluation requirements and competitive profit splits. Lilu Trading offers both single-phase and two-phase evaluations. Their single-phase evaluation is faster. Just prove profitability once, and you're funded. They also provide some interesting perks like their first profit withdrawals being at 100%. You keep everything initially before the profit split kicks in on subsequent withdrawals. Key factors to compare across firms include evaluation structure. Is it one phase or two phases? One phase is faster but typically has stricter requirements. Two phases take longer, but often have more achievable targets per phase. Look at the profit targets and loss limits. Some firms require very aggressive profit targets that might not suit your trading style. Others have more realistic goals that align better with consistent, conservative trading. Check the minimum trading days requirement. Some firms require 8 to 15 trading days minimum, ensuring you don't just get lucky with one or two trades. Others, like Apex, have no minimum, allowing very fast evaluation completion. Examine the rules around news trading and overnight holds. If your strategy involves trading major economic releases or holding multi-day positions, ensure your chosen firm permits this. Consider the monthly fees. Evaluation accounts typically have a monthly subscription fee. Some firms offer cheaper resets if you fail an evaluation, while others require purchasing a completely new evaluation. Look at the profit split structure. Does it start at 80% and increase to 90% after certain milestones? Do they offer any 100% profit perks initially? Finally, research the firm's payout reliability and customer service reputation. Read reviews from actual funded traders. Are payouts processed quickly and reliably? Is customer support responsive when issues arise? My recommendation: start with paper trading to develop your strategy. Then choose a prop firm whose rules align with your trading style. Don't just pick the cheapest evaluation. Consider the complete package of rules, requirements, and trader support. Many successful futures traders have accounts with multiple prop firms, diversifying their income streams and gaining exposure to larger combined capital. For those of you trading from the United States, let's discuss one of the most significant advantages of futures trading: favorable tax treatment under Section 1256 of the Internal Revenue Code. This can save you thousands of dollars annually. Under normal circumstances, if you're day trading stocks or Forex, all your short-term profits, positions held less than 1 year, are taxed as ordinary income. Depending on your tax bracket, this could mean a tax rate of 22, 24, 32, or even 37% on those profits. Rather steep, particularly if you're actively trading and all your gains are short-term. Futures contracts, however, receive special treatment. Under Section 1256, your futures trading profits are split into two categories for tax purposes: 60% of your gains are taxed at the long-term capital gains rate, and 40% are taxed at the short-term rate. Let me explain why this is brilliant. Long-term capital gains rates are significantly lower than ordinary income rates, typically 0, 15, or 20% depending on your overall income. So even though you're day trading, holding positions for minutes or hours, not years, 60% of your profits get taxed as if you held them long-term. Let's work through an example to illustrate the savings. Suppose you make $100,000 profit from futures trading in a year, and you're in the 24% ordinary income tax bracket. Without Section 1256 treatment, like with Forex or stocks, you'd pay 24% on the entire $100,000. That's $24,000 in taxes. With Section 1256 treatment for futures, $60,000 gets taxed at the long-term rate, let's say 15%. That's $9,000. The remaining $40,000 gets taxed at your short-term rate of 24%. That's $9,600. Total taxes, $18,600. You've saved $5,400 simply by trading futures instead of Forex or stocks. Over a career of trading, these savings compound dramatically. Another advantage, Section 1256 contracts use mark-to-market accounting. This means that at the end of each tax year, all your open positions are treated as if you closed them, and you recognize gains or losses accordingly. While this might seem complicated, it actually simplifies your accounting. You don't need to track every single trade throughout the year in the same detail required for stocks. Additionally, if you have a particularly bad year with losses, Section 1256 losses can be carried back up to 3 years to offset previous gains, potentially getting you refunds on taxes paid in prior years. They can also be carried forward indefinitely to offset future gains. Important caveat: I am not a tax professional, and tax law can be complex with individual circumstances varying widely. You should absolutely consult with a qualified tax accountant or tax attorney who understands Section 1256 and can advise you specifically on your situation. However, the general principle stands. Futures trading provides significant tax advantages for U.S. traders compared to other instruments. When you're evaluating which markets to trade, factor in this tax benefit. That extra 5 to 10% you keep could make the difference between an okay year and an excellent year. Keep detailed records of all your trades, account statements, and relevant documentation. Come tax time, provide everything to your tax professional, and they'll handle the Section 1256 reporting properly on your tax return. This is one area where the complexity is absolutely worth the savings. Let's consolidate the essential risk management principles that separate successful futures traders from those who blow up their accounts. These aren't suggestions, they're requirements for long-term survival. First, and absolutely foremost, risk only a small, fixed percentage of your account per trade. The standard recommendation is 1 to 2% maximum. Some shorter-term traders use up to 5%, but this increases volatility dramatically. If you're risking 10, 20, or 50% per trade, you're not trading, you're gambling, and the house always wins, eventually. Why such small percentages? Because losing streaks happen. Even the best strategies have periods of drawdown. If you risk 10% per trade and lose 5 in a row, not uncommon, you're down 50%. Recovering from a 50% drawdown requires a 100% gain. Risk 2% per trade, lose 5 in a row, and you're only down 10%, which requires just an 11% gain to recover. Second principle: size your positions from your stop-loss distance and dollar per point value, not from what you can technically afford. Don't ask how many contracts can my margin support. Ask instead, given my stop-loss placement and risk percentage, how many contracts should I trade? We've covered the calculations extensively. Use them. Third, maintain substantial cushion beyond minimum margin requirements. If your broker requires $500 intraday margin for ES, don't trade with a $600 account. Have at least 5 to 10 times the minimum margin requirement. This cushion allows your positions room to breathe during normal market fluctuations without triggering margin calls. Fourth, avoid trading during major news events. We discussed this extensively earlier. The risk is simply not worth the potential reward. Even if you think you can profit from news volatility, the slippage, spread widening, and unpredictable price action make it essentially a coin flip. Professional traders step aside during major releases. Fifth, always start on a simulator account. Before risking real money, whether personal capital or prop firm evaluation, spend significant time on paper trading. Prove your strategy works, develop your execution skills, and build confidence in simulated conditions that mirror real market behavior. Only after consistent simulator success should you transition to live trading. Sixth, begin with micro contracts when going live. Even if your account can support minis, start with micros. The psychological pressure of real money is vastly different from paper trading. Micros let you experience that pressure with minimal financial consequence while you adjust to live market conditions. Seventh, keep detailed trading records. Log every trade, entry price, exit price, reason for the trade, what worked, what didn't. Review these regularly to identify patterns in your performance. Are you better in the morning or afternoon? Do you perform worse after losses? Which setups have the highest win rate? Data-driven self-awareness is how you improve. Eighth, never add to losing positions. This cannot be stressed enough. Averaging down or adding to a position that's moving against you is one of the fastest ways to catastrophic losses. If your analysis was wrong and price is moving against you, admit it, take the loss, and move on. Only add to winning positions that are confirming your analysis. Ninth, respect your daily loss limits. Set a maximum loss per day, and if you hit it, stop trading for that day. Emotions after losses impair decision-making. Revenge trading, trying to immediately make back losses, almost always leads to even larger losses. Walk away, clear your head, come back tomorrow fresh. Finally, focus on process, not results. Individual trade results are largely random. Your edge plays out over hundreds of trades, not in any single trade. Don't judge your trading by whether your last trade won or lost. Judge it by whether you followed your rules, executed properly, and managed risk correctly. Good process eventually produces good results. These principles aren't exciting. They don't make for dramatic success stories. But they're what keeps professional traders in the game year after year while novices blow up and disappear. Master risk management, and you've solved 80% of the trading puzzle. Let's consolidate the absolutely essential concepts you must remember about futures trading. These are the foundations upon which everything else builds. First, futures are traded on regulated, centralized exchanges. This is fundamentally different from Forex and CFDs. You're not trading against your broker. You're trading on professional exchanges like the CME with transparent order matching and genuine liquidity. This regulation provides a level playing field and reliable market integrity. Second, understanding the dollar per point value is crucial. Each market has a fixed amount per point of movement. NQ is $20 per point on minis, $2 on micros. ES is $50 per point on minis, $5 on micros. Once you know this value, risk calculation becomes beautifully simple: multiplication. This simplicity is one of futures' greatest advantages. Third, micros enable precise risk control for smaller accounts. You don't need $50,000 to trade professionally. With micro contracts at 1/10 the size of minis, you can start with proper risk management using just a few $1,000s. Micros aren't training wheels. They're precision instruments for exact position sizing regardless of account size. Fourth, always trade the front month contract. That's the contract with the highest volume, which expires soonest. Check the CME website volume data to identify it. Trading old contracts with diminishing liquidity leads to poor fills and unreliable price action. Front month trading is non-negotiable. Fifth, contracts expire quarterly and must be rolled. For indices, that's March, June, September, and December, the HMUZ quarterly cycle. Roll your positions about a week before expiration, when volume begins shifting to the next contract. Set calendar reminders so this never catches you by surprise. Sixth, respect the leverage. Futures offer tremendous leverage. You can control $200,000 of exposure with just a few $100s of margin. This magnifies both gains and losses. Never treat low margin requirements as an invitation to over-leverage. Calculate position size based on risk percentage, not maximum possible contracts. Seventh, Avoid open positions during major news events. The spreads widen, fills become unpredictable, and prices can gap violently. Professional traders step aside during CPI, NFP, FOMC releases. The opportunity cost of missing potential trades is nothing compared to the very real cost of catastrophic slippage during news volatility. Eighth, margin requirements vary significantly between traditional and discount brokers. Traditional brokers require more capital but provide more cushion. Discount brokers allow smaller accounts but require exceptional discipline. Understand your broker's requirements and ensure you have substantial cushion beyond minimums. Ninth, risk management is 80% of trading success. Risk a small fixed percentage per trade, typically 1 to 2% maximum. Size positions from stop-loss distance, not from available margin. Maintain daily and weekly loss limits. These rules aren't optional, they're survival requirements. Finally, there's no substitute for extensive paper trading before risking real capital. Months of simulated trading where you prove consistent profitability is not wasted time, it's essential preparation. The traders who skip this step, almost universally, fail quickly. Those who embrace it give themselves a genuine chance of long-term success. These takeaways represent the distilled wisdom from decades of professional futures trading. Print them out, review them regularly. When you're tempted to break one of these principles, and you will be tempted, remember that these rules exist because countless traders learned them the hard way. Learn from their experience rather than repeating their expensive mistakes. Let's consolidate the absolutely essential concepts you must remember about futures trading. These are the foundations upon which everything else builds. First, futures are traded on regulated, centralized exchanges. This is fundamentally different from Forex and CFDs. You're not trading against your broker. You're trading on professional exchanges like the CME with transparent order matching and genuine liquidity. This regulation provides a level playing field and reliable market integrity. Second, understanding the dollar per point value is crucial. Each market has a fixed amount per point of movement. NQ is $20 per point on minis, $2 on micros. ES is $50 per point on minis, $5 on micros. Once you know this value, risk calculation becomes beautifully simple: multiplication. This simplicity is one of futures' greatest advantages. Third, micros enable precise risk control for smaller accounts. You don't need $50,000 to trade professionally. With micro contracts at 1/10 the size of minis, you can start with proper risk management using just a few $1,000s. Micros aren't training wheels, they're precision instruments for exact position sizing regardless of account size. Fourth, always trade the front month contract. That's the contract with the highest volume, which expires soonest. Check the CME website volume data to identify it. Trading old contracts with diminishing liquidity leads to poor fills and unreliable price action. Front month trading is non-negotiable. Fifth, contracts expire quarterly and must be rolled. For indices, that's March, June, September, and December, the H, M, U, Z quarterly cycle. Roll your positions about a week before expiration, when volume begins shifting to the next contract. Set calendar reminders so this never catches you by surprise. Sixth, respect the leverage. Futures offer tremendous leverage. You can control $200,000 of exposure with just a few $100s of margin. This magnifies both gains and losses. Never treat low margin requirements as an invitation to over-leverage. Calculate position size based on risk percentage, not maximum possible contracts. Seventh, avoid open positions during major news events. The spreads widen, fills become unpredictable, and prices can gap violently. Professional traders step aside during CPI, NFP, FOMC releases. The opportunity cost of missing potential trades is nothing compared to the very real cost of catastrophic slippage during news volatility. Eighth, margin requirements vary significantly between traditional and discount brokers. Traditional brokers require more capital but provide more cushion. Discount brokers allow smaller accounts but require exceptional discipline. Understand your broker's requirements and ensure you have substantial cushion beyond minimums. Ninth, risk management is 80% of trading success. Risk a small fixed percentage per trade, typically 1 to 2% maximum. Size positions from stop-loss distance, not from available margin. Maintain daily and weekly loss limits. These rules aren't optional, they're survival requirements. Finally, There's no substitute for extensive paper trading before risking real capital. Months of simulated trading where you prove consistent profitability is not wasted time. It's essential preparation. The traders who skip this step, almost universally, fail quickly. Those who embrace it give themselves a genuine chance of long-term success. These takeaways represent the distilled wisdom from decades of professional futures trading. Print them out, review them regularly. When you're tempted to break one of these principles, and you will be tempted, remember that these rules exist because countless traders learned them the hard way. Learn from their experience rather than repeating their expensive mistakes. As we conclude this comprehensive guide, let me offer some final recommendations for your futures trading journey based on what separates consistently profitable traders from those who struggle. First recommendation: master one market completely before diversifying. Choose either ES or NQ, just one, and trade it exclusively for your first 6 months to a year. Learn its personality intimately. Understand how it moves during different sessions, how it responds to news, its typical ranges, its quirks, and patterns. This depth of understanding in one market is far more valuable than surface-level knowledge of many markets. Once you're consistently profitable in your chosen market, then consider adding others. But start focused. Second, trade during liquid hours initially. The U.S. regular trading hours from 9:30 a.m. to 4 p.m. Eastern Time is where volume, liquidity, and reliable price action are highest. As a beginner, stick to these hours. Yes, futures trade nearly 24 hours, but the overnight sessions have lower volume and can be trickier to navigate. Once you've proven profitability during RTH, then explore overnight trading if it interests you. But start where conditions are most favorable. Third, keep your risks small and consistent. I cannot emphasize this enough. 1 to 2% per trade is not a suggestion, it's a requirement for long-term survival. Many beginners think, I'll risk more per trade to build my account faster. This thinking leads to account destruction during inevitable losing streaks. Small, consistent risk allows you to survive the learning process and stay in the game long enough for your edge to manifest. Fourth, track your metrics meticulously. Maintain a trading journal documenting every trade. Record not just entry and exit, but your reasoning, your emotional state. What worked, what didn't. Review this weekly. Calculate your win rate, average win versus loss, profit factor, maximum drawdown. This data tells you what's working and what needs adjustment. Trading without metrics is like flying blind. You might feel like you're doing well, but you have no objective evidence. Fifth, consider prop firm funding after demonstrating simulator consistency. Don't jump straight into prop firm evaluations from day one. First, prove you can trade profitably on a simulator for several months. Then, take a prop firm evaluation. This approach allows you to learn and develop your edge using their capital rather than your own, while still requiring you to demonstrate competence before risking even the evaluation fee. Sixth, accept that this is a marathon, not a sprint. Futures trading is a skill that takes time to develop. Expect 6 to 12 months minimum before you're consistently profitable. Many traders take longer. That's normal. Anyone promising you'll be profitable in weeks is selling you something. Embrace the learning process, view early losses as education costs, and maintain patience as you develop competence. Seventh, continuously educate yourself, but avoid information overload. Yes, keep learning about market structure, order flow, volume analysis, and various strategies. But don't chase every new indicator or system that promises the Holy Grail. Once you have a working strategy, focus on execution mastery and psychological development, rather than constantly seeking new methods. Eighth, protect your physical and mental health. Trading is psychologically demanding. Ensure you're getting adequate sleep, exercise, and time away from screens. Don't trade when you're tired, stressed, or emotional. Your trading performance is intimately connected to your overall well-being. Professional traders understand this and manage their health as carefully as they manage their risk. Finally, remember why you're doing this. Whether it's financial independence, location freedom, intellectual challenge, or something else entirely, keep that motivation clear. There will be difficult days, losing weeks, periods of frustration. Your deeper purpose will sustain you through these challenges and remind you why the effort is worthwhile. Futures trading represents one of the most professional, most liquid, most efficiently structured markets available to retail traders. You're trading alongside institutions using the same tools, seeing the same prices, accessing the same opportunities. This is a remarkable privilege. Approach it with the seriousness, discipline, and respect it deserves, and futures trading can provide you with tremendous opportunities for financial growth and professional satisfaction. Best of luck on your trading journey. Questions and resources. As you begin your futures trading journey, having the right resources and support is essential for continued learning and development. Essential references: the CME Group website at cmegroup.com is your primary resource for contract specifications, margin requirements, expiration calendars, and trading hours. Bookmark this site and refer to it regularly. Additionally, your broker's education center will provide platform-specific tutorials and trading guides. Prop firm resources. If you're considering funded trading accounts, explore TopStep Apex Trader Funding, OneUp Trader, and Lilu Trading. Each offers evaluation programs with different rules and profit splits, so compare them carefully to find the best fit for your trading style. Platform documentation. Whether you choose NinjaTrader, Trade8, or TradingView, thoroughly study their documentation and video tutorials. Understanding your platform's order entry, risk management tools, and chart features is crucial for efficient execution. Community and continued learning. Join trading communities, participate in forums, and follow experienced futures traders who share educational content. Remember that futures trading is a skill that develops over time through education, practice, and disciplined risk management. Now, as we close this comprehensive guide, thanks so much for watching today's video. I really appreciate you taking the time to tune in. It means the world to me. If you enjoyed it, make sure to follow me across all platforms so you don't miss future content. And remember to like and subscribe, as well as leaving your questions and comments, as they are invaluable for future content ideas and refinement. Down in the description, you'll find links to the brokers I personally use, some backtesting software I recommend, and of course, our free Discord community where you can connect and learn alongside other traders. And as always, remember, strive for progress, not perfection. I'll see you all in the next one. May God bless and protect you always. Amen.